Great to be here. Great to be back at Hopkins. When Hossein reached out and asked, I was like, great. Even though it's summer and it is hot as hell, and looked at the forecast in New Hampshire, it's in low 70s right now. So it's kind of painful. We've got all this smoke, I guess, the construction crews at the White House unleashed a portal to the gates of hell somehow. I have tenure, so I can say these things, even if it's being recorded. So maybe I'll chill a little bit. So excited to be here to talk about the tax expenditure, tax exemption for nonprofit healthcare, and what I'll actually kind of start doing a little bit. I don't see a clicker. Is the call? Okay, cool. So we're going to talk about the nonprofit tax exclusion for the bulk of this session number 2. But when we kind of got on our pre-conference meeting to kind of talk about the things we'll discuss, we kind of agreed that it might make sense to actually talk about tax expenditures more broadly. And so in some sense, asking an economist to come to a captive audience about tax expenditures, it's like, yes, sign me up, despite the hot weather, despite that it's summer, despite that it's so smoky. So talking about the tax expenditures in the context of nonprofit hospitals, we'll kind of broaden out a little bit, talk more about policy and financial realities. But first, just a couple of quick slides to kind of back out further from nonprofits in general, and even kind of the nonprofit tax exemption, and think about just kind of tax expenditures more broadly, right? And so if we think about tax expenditures more broadly, and we think about what does the government do? Government collects taxes and then spends money on things. Well, tax expenditures are kind of simultaneously both, but also kind of simultaneously neither, right? And so to really kind of think about the nonprofit tax exemption, I think it's kind of helpful to think about the nonprofit tax expenditure in the context of tax expenditures overall. But to get to tax expenditures, you kind of have to spend a little bit of time thinking about the initial tax revenues, right? And so when it comes to tax revenues, we can think about taxes broadly is kind of having these 3 possibilities, right? We're either taxing earnings, we're taxing sales or consumption, or we're taxing assets. And when it comes to income and earnings, right, you really kind of think about we've got some, income on individuals, some income tax on corporations. We've got a dedicated payroll tax for Social Security, Medicare, disability insurance. And then when we think about sales taxes, we can think about broad sales taxes, or sometimes we can think about kind of dedicated excise taxes. And again, assets, right? That's another possibility. So another dimension, we can kind of think about taxes differing are federal versus state versus local, right? And so when we get to the nonprofit tax exemption, we're going to see evidence of each of these pieces, right? Difference in terms of earnings versus sales versus assets, differences for federal versus state versus local. And so again, kind of thinking about this from the big picture perspective at first, right? We've got tax revenues coming in, got spending going out, right? Spending's a little easier in terms of thinking, at least on the federal side. There's mandatory spending, there's non-mandatory, discretionary, and net interest. When we think then about the tax expenditures kind of falling somewhere in the middle, right? Well, the underlying goal is to kind of target some of these things we want to spend money on, right? What do we want to kind of accomplish? But we're going to kind of do that through collecting less tax revenue, right? So we can kind of think about this in several different ways, right? Tax expenditures broadly. But within tax expenditures, there are exclusions. There's itemized deductions, preferential tax rates, and tax credits, right? So before honing in on the nonprofit exemption, the biggest exclusion I think we can kind of think about is the exclusion for employment-based health insurance. And so health economists, health policy analysts really, really kind of focus a lot, self-included, on the inefficiency and inequity of that exclusion. And if you think about like an exclusion versus a deduction, an exclusion is saying, well, there's something that we're just not going to count as income in the first place, right? Whereas the follow-on with a deduction, an itemized deduction, is saying, well, we've got your income, and now we're going to allow you to deduct certain things like charitable deductions, mortgage interest, so you have a lower taxable income. Right? Preferential tax rates, I kind of started up top saying some overly simplified stuff. You really can get in the weeds on tax expenditures. Tax credit's a huge deal, right? Just in terms of health policy, broadly speaking, in terms of the marketplace tax credits, but not so directly relevant to hospitals for us today. Okay, so with this kind of setup, right, the nonprofit tax exclusion, right, as we talked about several times already, right, it's the IRS determining who is exempt from taxes, right, beyond just hospitals, but the Atlanta Humane Society or homeless advocacy groups, right? But one thing that's kind of interesting to think about a little bit before going into more detail about the hospital exemption is, for the most part, if you think about these tax expenditures and think about the whole range of tax credits, preferential tax rates, itemized deductions, many exclusions, these are things explicitly written in law by Congress, right? Laws pass specifying exactly, what's to be done, what is the rate, what is the dollar amount, how does it, phase out, whatever. Whereas the exclusion is the thing where it's not so much in law, it's kind of left to, as we talked about before, like the discretion to the IRS, okay? If I also kind of say back on here, right, if we think about the expenditures, exclusions, being a reduction in your taxes that you pay, and we can kind of think about these two dimensions, earnings versus sales versus assets, federal versus state versus local. There's actually, in some sense, a third that I'll point to, right, in terms of how nonprofit hospitals explicitly benefit from the tax exemption, right? There's a set of direct benefits that have to do with taxes they're no longer paying, which we'll get to in a second. But there's also kind of like this indirect benefit to nonprofit hospitals that don't really relate to the taxes they pay, but relate to taxes that other people pay that in turn benefit them, right? So we've kind of hit on all these things, but I think it's kind of important to kind of say, well, okay, yeah, there's these 6 things ultimately, right? There's federal corporate income tax, there is state corporate income tax that nonprofit hospitals are exempt from paying. If your state has a sales tax, and unless your state has said, no, we're actually going to make you pay that sales tax, nonprofit hospitals are exempt from paying state sales taxes most everywhere. And then there's local property taxes, right? So again, we kind of see the federal versus state versus local dimension here. And we also see the earnings versus sales versus assets dimension here, okay? And then, right, these indirect benefits, essentially nonprofit hospitals get access to lower interest loans through tax-exempt bonds, right? And so if you're an investor, right, so not thinking about the nonprofit hospital itself, but you're an investor and you're investing money, and one option is, well, I can earn a 5% return but have to pay taxes on that. Or if I'm at a 20% tax rate, which is probably pretty low, and pay a 4% or receive a 4% interest rate, right? You kind of equate those things, right? Taxes on 5% is going to be about the same after taxes 4, so that in turn this benefits the nonprofit hospitals by getting access to these lower interest loans. Okay? And then the other thing is the charitable deductions they receive. And again, this is not so much from the nonprofit hospital itself and the tax incentive, but the incentives that individuals face in terms of where am I going to donate my money, or am I going to donate money and am I going to direct it to these nonprofit hospitals with their charitable mission? Okay, and so a lot of talk, a lot of estimates of billions, millions. I like to kind of think about things in percentages, and so kind of based on the earliest work that kind of Hussein, Jerry, and Daryl and I did, all these things kind of added up, or about 6%, almost 6% of hospital expenditures. Right? So not huge, not trivial, right? It's kind of in there. And again, right, the underlying intent is really kind of all about like, well, are these foregone taxes exceeded by the community benefits? And so we're really just going to focus on the former, focus on the taxes, the tax exemption, and kind of leave to session 3 thinking about the community benefits. Okay, so this is my intro. We're going to have our first speaker kind of maintain this relatively broad, big picture perspective, really kind of thinking about healthcare reform, thinking about tax deductions as maybe just one piece of this. And that's Cathy Koch from the Peter G. Peterson Foundation, who will talk a little bit about these issues. Okay, so then we're going to hone in on one of these aspects of the tax exemption that's pretty, I think, poorly understood, complex, and that is the hospital property tax exemption, the local property tax exemption, and that'll be Judith Garber from the Loan Institute. And then we'll kind of circle out bigger picture, think about how the tax exemption and broader finances like impact hospital behavior. And there we're going to have Elena Patel talk about just that. And she's from the Irving-Brookings Tax Policy Center. And then we'll have kind of a brief, big picture set of comments from Zach Levinson from the KFF Project on Hospital Costs, focus maybe a little bit on the data as he's worked on those issues. We'll have a few questions that I'll lead, and then we'll open it up to the broader panel, similar to how session 1 was scheduled. Cool? Okay, so thanks for your interest. Let's bring up Cathy, and I'm gonna see if this brings up her picture. No. Well, I'll keep that one up. Yeah. Okay. Cool.
So I was going to sit here with the group, but I guess I'm not. That's fine. He's tall, taller than me. So I love the introduction. I love when people talk about tax and healthcare, because I think a lot of healthcare people before the ACA, anyway, in my career in the Senate, nobody ever thought tax people knew anything about healthcare. That still may be true to a large degree amongst my colleagues, but in my profession, that is. But what I was asked to talk about, and I do think it's directly related, is, how did we pay for the ACA, and how that whole and the process evolved, and then that has ramifications for the 501c3 for tax-exempt hospitals. If anyone wants to expand that, wants to contract it, anything you do to any of these tax proposals that are healthcare related are going to be impacted by the same, I think, political and economic forces that we dealt with in ACA. I don't know if Liz Fowler is in the room yet, but Liz and I worked really closely on the ACA, and it was, a very interesting kind of process. I think as a tax team, we were doing all kinds of more kind of traditional corporate taxes, individual taxes. Tax exempt, of course, is a big deal for tax people, but to find out that we were paying for an entire healthcare bill was a bit of a shock, and it was hard. It was really hard. And one of the first rules that we laid down in paying, in developing the pay-fors for the ACA was healthcare for healthcare. and that was going to be less politically dangerous. It was going to be easier. If you're getting the benefit and you're paying for it all in the same sector, that just makes a lot more sense. And for a little while, that worked. And I would say little is the operative word in that sentence. So we started out with HSA provisions. Let's look at health savings accounts and what you're allowed to spend it on and how much you're allowed to put in there. Let's look at your MSAs, additional tax on distributions for non-health related issues. We looked at all these other things. Limit flexible savings accounts. Limit what you're allowed to spend those funds on. I know we looked there. We did look at 501c3s in that beginning tranche, right? We looked at community benefit and the measurement thereof. Then we kind of went a little bit further. We raised the floor on deductible medical expenses. Right now it's it used to be 7.5%. If you spent 7.5% of your income on medical expenses, you could deduct them. We raised the floor to 10%. Then we were moving on. We got to 833 Blue Cross Blue Shield, still in the healthcare business. And then we were out of money. And my colleagues on the health side, there is still one person in town who every time I see him asks me if I have $40 billion. And that, so we moved on. Now the Cadillac tax was still healthcare, but it had a bit of a different feel, right? And some of these things, as you might remember, disappeared almost as soon as they were enacted. But the Cadillac tax was a huge issue. It was a lot of fun. It was very interesting to see, what was the average, because we taxed, right, everything over the 80th percentile. We had some changing formula like that. So we went there. Then we limited the deductible remuneration for officers of healthcare organizations. And, that was something we learned in the TARP, right? We actually applied a similar rule to bank officials for failed banks. That seemed to be going well. Then we eliminated deductions for expenses related to Medicare Part D subsidies. Pretty soon we were reporting, cumulative spending on purchases for goods and services over $600 for all corporations. That's where we really started to fall apart. We raised $17 billion by requiring information reporting from corporations who spent money, on basically these were mostly small businesses. And that actually was repealed, April 2011, made it about 5 days. So as we moved out of the healthcare space, you start losing support. So then we moved into my favorite three, health insurance tax, the med device tax, and the pharma tax. That was actually one of the most interesting processes I've ever been involved in on a legislative process, because we had the industry had to come in and work with us, and they did. And to their credit, they were at the table. The pharma people were at my tiny little desk stuffed in the Senate Finance Committee, and we talked about how we could design such a tax. And remember, their tax used to look like the fund set up for tobacco damage. It was like that, right? We prorated it across all health pharmas. Then we moved into the med device tax, which started out looking the same way. I used to work for GE before I got there, so I thought, there's the difference between med devices and medicines. And, there's big med devices and then there's little med devices. And so we finally bucked that system by turning the med device into a 2.3% excise tax on sales. That's, that was a big deal. These are big money provisions. This is where a lot of our money came in. Then, because finally, we had med device, and then we had the health insurance tax. And that kind of made more sense. That was kind of the healthcare for healthcare. You're going to benefit. You're going to get more clients. You're going to get more business, so you're going to help pay. And all these businesses did come in and did cooperate with us and did share information and did work with us on the numbers. That was pretty amazing, I thought. Med device people were maybe the last ones to come in, but when we got the design right, they were there. And I would say on this point, the ACA would not have passed without business support, I don't think. And there was a lot of business organizations I'll name the BRT for one. What they were was large employers. So I told them never change, never change the way you're referred to, because as large employers, that's a very positive thing. But businesses came in, they worked with us, and the large employer community was critical to getting support we needed to pass this bill. So we're steaming along, and then, by the end, the healthcare for healthcare was kind of a cute little saying we used to have. Who remembers the tanning tax? The tanning tax was the greatest tax in history, in my opinion. Actually, Harry Reid, so I went to work for Harry Reid after the Senate Finance Committee, and you're always working with the leader's office when you're doing these big bills, and he decided, one day just picked up the phone, told his person, get me a tanning salon number. He called up, he asked how much it cost, and hung up the phone and said, put the tax on. It was the best ever. And we raised $2.7 billion, which isn't a lot compared to the bill, but it's not nothing. And I was so sad when it got repealed, I must say. Not because I don't like tanning beds, but that's where we were. Just what can we do to make the ends meet? That we limited the biofuel tax credit. If you probably don't recall that because nobody's eyes were on those kind of things, $23 billion we got from that. We codified the economic substance doctrine. Economic substance doctrine is a really esoteric tax concept. Does a transaction have economic substance, or is it just done, for money, basically? Has nothing to do with healthcare, $4.5 billion. Then we increased corporate estimated tax payments. We raised $8.8 billion like that. By increasing estimated corporate tax payments, we're not raising any money. We're pulling them into the window. So we, at this point, things are pretty tight, but we got it done. And, I'm really proud of what we did. I think it was a good thing. It's still alive. I'm really proud of that. But a lot of the non-tax stuff did kind of, drop out after a while. And so what we needed to do to get political support that the beneficiary would pay was basically the idea between the industry numbers and a lot of the other numbers, FSAs, all of those things. It's for the beneficiary here so we can reduce their tax benefit over here. And that's kind of how we did it. A lot of that stuff finally did drop out. But now we have other forces coming, and I know we're talking about hospitals here, and they do have a tax exemption, and of course, people are starting to look at things like that. One of the reasons they're starting to look at all kinds of tax expenditures across the board is because we have a huge deficit problem. Now, I'm from Peterson. That's what we do. We talk about debt and deficit. That's not why I'm raising it. I'm raising it because it's a true issue. Right, we're at 100% debt to GDP. We hit that just a little bit ago. We hit 39 trillion in debt. We're rounding the corner to 40 trillion. These are big numbers, and they're unprecedented for this economy. Right now in this economy, we pay more for interest than we pay for infrastructure, education, and R&D. So we're paying more out the door in interest than we are in investment in this economy. That's really not a good solution. As any economist, you have to invest to grow. So in addition to the forces that debt is creating higher interest rates. Also, they have all kinds of, collateral impacts across the economy. We're also now facing Social Security depletion in 2032, and as someone mentioned before, Medicare depletion in between 2033 and 2040. So these events could cause fiscal activity. At some point, for Medicaid, when Social Security depletion day, every senator that gets elected this election period is going to have to face the Social Security depletion date and decide what to do about it. And a general fund transfer, just like pretending that didn't happen and deepening the hole, I would say if we did it today, we wouldn't do a general fund transfer. I don't know what it'll be like in 2032, but people are starting to take this seriously because there are interest rate pressures. And, mortgages, look at mortgage rates, look at all these other things. It's bleeding down to households. They're starting to notice. So as this fiscal squeeze comes, and by the way, it hits a demographic that is active, right? They vote, seniors vote and they believe they're owed all of these things. And I'm for them. I think they're owed that too. But it's a cohort that is politically potent. And so as these things happen, all tax expenditures, the ESI, the employer-sponsored insurance deduction, huge. It's one of our hugest tax expenditures. And, I'm not saying it's wrong or right? It's considered an individual tax expenditure because it's in-kind wages, right? And so otherwise you'd be taxed. But there's a whole slew of tax expenditures for healthcare. I'll just show you a visual list. But all these things could come under pressure, could come under like a closer microscope of who's benefiting and do they need it, or do they change behavior? When we look at tax expenditures, we want to know, do they change behavior? We want to know, does the tax exemption for tax-exempt bonds, does that make you invest in those bonds, versus other bonds? And if it doesn't change behavior, one has to start to wonder, think about where resources are being allocated. So I would say that right now, a lot of tax expenditures are going to be examined, and healthcare in particular, it's one of the largest categories of tax expenditures. I wanted to address one other thing before I finish, and I think there was some question when I was in the room about how did the IRS get involved in all this? Because the poor IRS, right? Everything we do, we just energy tax, it's like everything we just dump on these poor people that are there to do a good job of collecting revenue and allocate it and account for it and check your returns and help you file, by the way. That's, there's not a lot of people left to do that. But I will just tell one tiny little story from the very end of our negotiations on the ACA. We were sitting in like one of those rooms, and it's like 100 o'clock, and we've got the, the premium tax credit. We have this all pretty much worked out. And then that, how are we going to do that? Like, who's going to get this premium tax credit to the people? And there across from me was, her name is Helen Morrison, sitting from the IRS, just trying to be small. We decided, we'll do this through the IRS. And they really had no choice. But it's interesting, the IRS gets involved. The IRS manages a lot of social programs, and they really do a good job, and they collect great data, actually. So, the IRS was not, I'm sure they didn't go home and have a party because they were also going to be, doing healthcare, but they've done a pretty good job, I think, so far on at least the information reporting and refunds and things like that. Right? Can you imagine the massive headache they had when they went home and had to plan for that? So the IRS is involved, and I think inextricably, and healthcare is no longer really the rule, but many, many, many tax expenditures, particularly in healthcare, it's the first place to go if you're trying to raise money to do something for broader purposes. And it's also, some of these things can be rationalized, some of them can be tightened, some of them can't be. But it will be an active discussion, and I hope everyone is here for it because we need we need experts in the room when these things are being examined. So that's all I have. No, thank you.
Hello, everyone. My name is Judith Garber. I'm a senior policy analyst at the Lown Institute. We're a very small, nonpartisan think tank based in Boston and working on hospital issues and other issues of social responsibility in medicine for quite some time. So I'm going to talk a little bit about the property tax exemption in particular and why property taxes. It's not the largest part of the hospital tax exemption overall. It's, I think, about 20% overall, but it's local. It's stable, at least compared to income, which goes up and down. And the data can be really hard to find. So that's why we're talking about it right now. And every family is paying either rent or property taxes themselves to support their local schools, community, and they care about organizations paying their fair share. And municipal budgets are under a ton of stress right now, as are state budgets. So this issue is becoming more important. So We wanted to take a comprehensive look at property tax values. My colleague Noelle, who's here today, has spent many months of work to uncover insights about the hospital property tax exemption using local assessment data and down to the parcel level. A really fantastic effort. And what we find is the amount of the property tax exemption is quite substantial, but it's really unevenly distributed. This goes back a lot to what Jerry was saying earlier. You'll find that it's the issue in the property tax is kind of exemplified in the larger tax exemption more broadly, and just wealth also. And it's distributed differently based on location and hospital size, and we also find issues in transparency in many states. So we were able to get data for 2,073 hospitals, which is most of the private nonprofit hospitals in the U.S., but not all. And overall, the real estate tax exemption was worth about $6.1 billion to hospitals in 2023. That's not including equipment, which adds another like $1.5 billion, but not all states tax equipment. So on average, your hospital is gaining $3 million in real estate tax exemptions, but it's super skewed, as you can see from this chart. So the top 1% of hospitals by property value, it's like 21 hospitals, they're collectively receiving nearly 18% of the total real estate tax exemption, over $1 billion. And if you look at the top 20%, they're totally comprising over 70% of the total property tax exemption. So let's just look at these top 1% of hospitals. What do we know about these hospitals? Generally concentrated in coastal cities where property values are highest, and they're usually really, obviously very large, often comprising multiple campuses. So our unit of measure for this was the CMS ID, but some CMS IDs actually include many hospital campuses. It's a little bit of a cheat there, but that's how the CMS ID works. So, many of these hospitals own more than $1 billion in real estate value, assessed value, not even market value. And out of these 20 or so hospitals, 30% of them were spending more on financial assistance than they received in that property tax exemption. And here's a little bit about, like, if you look at on a city level, these are the cities with the largest real estate tax exemptions. Most of them are on either the East Coast or Midwest. New York and Boston are really clear outliers here, and they have total tax exemption values over $200 million. That's for all the hospitals in the city together. And what's interesting here is that in some cases, the total property tax exemption actually exceeds what the city or county's public health budget is. So, for example, in Boston, the total amount of property tax exemption would actually pay the public health budget in the city for 2 years. And it also exceeds the public health budget by millions in Houston, Columbus, Orlando, Cleveland, and Hartford. And that's just out of the 20 cities we were looking at that have really large amounts. And this kind of ties a lot back to what Dr. Benjamin was saying about the importance of working with local public health departments in making sure that we're all serving the same goals here. And I'll talk just really briefly about what we talked about what some states are doing to make sure the hospitals are giving enough back. We have some states that have thresholds for minimum amounts of community benefit spending. There are some cities that require, or actually mostly it's voluntarily ask hospitals to pay in a little bit of extra to the city to serve things like public safety and water that they're benefiting from, even though they're not paying into it. But I also want to talk a little bit about some of the transparency issues. So there were 12 states where most of the hospitals didn't actually have property values available, either because the state doesn't assess nonprofit property. Why would you spend resources assessing property you're not going to tax? So I guess I understand it. Or so in some cases, it's not made available. So one thing to point out interesting here is that Illinois actually has a requirement, one of those requirements that community benefit spending has to exceed their property tax exemption. So imagine our surprise when we actually couldn't find out the amount that hospitals, were gaining in this tax exemption. So it's not in any centralized area on the website. You'd expect it like is an AG website. No, it's not there. It's not really anywhere. What we found out is that hospitals submit a form to the city with their property tax information, but they're not published anywhere. You have to email the city individually to get it, and that is what Noelle did. And you only got majority of hospitals, we couldn't get them basically. So you have this great, well-intentioned law that's supposed to help hold hospitals accountable, but without the data behind it, like what power, like who's making sure they're actually paying enough. Let me see. Okay. Also, there's actually a bill in the State House in this past session that would address this issue. So cross fingers on that. Another state I wanted to highlight here is Michigan. So a couple years ago, Henry Ford Health was partnering with the Detroit Pistons and Michigan State on this huge new campus, including a hospital tower, commercial housing, retail, research space, which was a multi-billion-dollar development. But they don't have any of their property tax information available in Michigan. So how are community advocates going to be able to understand whether they're giving enough back given that huge expansion that they're doing? There's really no way to tell right now. So I hope we'll get to go into more of these issues in the discussion. Thank you.
Okay, my turn. Hello, everyone. I knew I was going to have to look at this clicker for a second, so I feel like I'm ready to go now. My name is Elena Patel. I'm the co-director of the Urban Brookings Tax Policy Center. I'm also a senior fellow in Econ Studies at Brookings. And I'm going to talk to you about broadly how tax-exempt regulation affects the behavior of tax-exempt hospitals, but it's going to be based on a paper that I've recently published. And so some of it will be broad, some of it will be about the paper. Happy to take questions at any time. Okay, so I'll start by saying something super obvious as a tax economist. So how do taxes affect firm behavior? So if you tax something, you get less of it. And if you subsidize something, you get more of it. And that's really like what underpins discussions about tax expenditures, what deductions are doing, what credits are doing, and how we sometimes kind of shove a lot of social, business, individual policy through the tax code. One might argue for the sake of convenience. It's just an easy way to get at behavior. So taxes and subsidies can be targeted at specific behaviors that are going to be relevant in healthcare and other contexts. So an example is the charitable deduction. If you subsidize charitable giving, you get more giving. It's as simple as that. And that's true on the individual side. It's also true on the corporate side. If you want more R&D investment, you can have an R&D tax credit. And then we know we get more R&D investment. And so this is how tax expenditures work. The nonprofit tax exemption, I would argue, is a little bit different than that in that it's a very broad subsidy, which has been the focus of the first session and a lot of what we're talking about today. So it's worth $37 billion. That's our most recent estimate in 2021. But the exemption is not necessarily aimed at anything in particular, which can make it hard to measure. It can make it hard to talk about benefits and costs of having such an exemption in the code to begin with. Why does it matter? So I worked at the Office of Tax Analysis for a long time, and I came in to OTA with a background in healthcare mergers. I was really interested in hospitals, and I got there and I'm like, great, I really, in addition to working on corporate tax, which is my background, I want to work on hospitals. And they were like, why? They're tax exempt. So it can be hard to have a conversation with tax economists about the tax exempt sector because I think a lot of people think that there's a one-size-fits-all solution to the tax exempt sector, especially if you're talking about fiscal questions of how can we close the current deficit. You might say, oh, we'll reform tax exempts, to which I would say, what do you mean by reforming tax exempts? The sector is very broad. It's like talking about the U.S. economy. And in particular, hospitals are really a different concept than the rest of the nonprofit sector. Right, so they are small by count. There are plenty of nonprofits. They're only about 1% of all organizations, but they're 25% of assets, 31% of employment, and 34% of total revenue reported in the sector. And so when I have conversations with people about reforming the tax-exempt sector, I often start by saying, do you mean hospitals? Do you mean education? Or do you mean YMCAs? Because those are all three very different buckets of tax-exempt. And because they all live near, I'm not a lawyer, so I don't want to talk too much about 501c3 without getting myself in trouble, but they live near each other in the Internal Revenue Code, and people tend to think of them as one bucket, and they're very, very different. So we're exempting this entire sector. The idea is we're going to get more of everything that they do across the whole sector. So what do we mean by more? More of what? The point of departure for the study that I recently published is really thinking about who watches the money and what the non-inurement clause is going to do, which is not actually often the thing people talk about with tax exempts, but I actually think it in the case of hospitals is imposing a lot of constraint in terms of corporate governance that can be costly. So what do I mean by that? In a taxable firm, from the standpoint of corporate governance, there are shareholders and there are residual claimant. And they serve a really important role in corporations. That's why all public companies are required to have boards of directors, for example, to monitor on behalf of the shareholders. They force surplus to be used well. We can decide and quibble about what that means, but it needs to be used well or else it needs to be returned to the shareholder. And tax exempts, because of the non-inurement clause, they don't have shareholders. And so there's no owner with a claim on surplus. Now, some would argue that's the whole point, but my point of being up here is just to say that may be the point, but you should recognize that that comes with costs, because now there's not an owner with any claim on the surplus doing the job that shareholders do. And with an asterisk that I should say, when I mean shareholders, I don't mean private equity. I think private equity in healthcare is a very different conversation, a very heated conversation. You should just think of sort of plain vanilla shareholders when I'm talking to you about this. There are creditors and trustees. It's not that there's not a board of directors. There's usually a board of trustees. They're there to watch, but they don't have the same stake in how the surplus is spent. And so I think that means that there's no one left to ask whether the surplus is worth it. What are we doing with the dollars? If they're staying inside the organization, how else might those dollars be used? And so if you go back to corporate finance, there are actually really clear predictions that support why we have mandated corporate governance structures that we have over large, complex entities. So there's an argument that's called free cash flow. So that just says that if surplus that isn't forced out often gets spent internally on ways that don't provide good return. And you've heard this in the context of hospitals when we talk about waiting rooms with Queen Anne furniture or executive offices with these beautiful desks in them. I think you could think of that anecdotally, but that's not so much what I'm going to focus on. I would just call that an internal direction of funds that might have otherwise gotten out of the organization. And the question is that the best use of the dollars? So when there's no shareholders to force the payout, that means that corporate governance makes some very classic predictions that may or may not be a problem in tax-exempt hospitals, which is what we study. So those predictions are, one, that cash is going to accumulate internally rather than being returned. And I would argue this is mechanically true for tax-exempts. They have no way to get cash out of the organization, so it sort of has to accumulate internally. And then because of that, you end up with overinvestment in buildings and capacity because that benefits management. You end up with administrative slack. That can be bigger payroll, that could be bigger overhead, that could be the really lush waiting rooms, and you get weaker return on all of that capital. And so then with that in mind, again, maybe some of this is by design. We're trying to keep the cash in the hospital to force it to spend the surplus on the mission. And so the question is that happening? So the thing I'll put aside is not to fixate too much on margins. I think we've accepted that tax-exempt organizations are going to have low or zero margins sort of by design. Okay, so that's of course. But the question is, are the lower margins because of mission spending? So maybe restrained pricing, maybe cross-subsidy for unprofitable services, or is it because of inefficiency, that we kept all this cash in the building and so therefore we built another building? Or we have spent more on general and administrative expenses and that sort of thing. And so there's two places it can go. They're not mutually exclusive. And what we set out to do was study sort of where is this happening. So this is a paper with my co-author, Brian Cadman, who's an accounting professor at the University of Utah. And we use the same data we all use. There's only 3 places to get data in the healthcare industry. And so we went to the Medicare cost report simply because the balance sheet with all of its thorns that comes with Medicare cost report balance sheet, it's at least reported for for-profit and nonprofit hospitals. And so you can do a comparison with all the caveats that come with that. So we look in the pre-sort of TCJA period, which felt important. TCJA changed corporate tax structure, which is going to affect for-profit hospitals. And we just do a benchmarking. We take for-profit hospitals and we compare them to matched nonprofit hospitals over the same period. So we match on a wide variety of things, characteristics of the hospital, size, patient mix, all, I think, the usual things that one tends to throw into these comparisons. And what we're trying to understand is when two like hospitals have different ownership structures, how does that affect the way things are showing up in the balance sheet? And so the first thing I'll tell you is, again, some of this is duh. Nonprofit hospitals cannot get cash out of the organization. And even in a matched comparison, they hold 6 times more cash than for-profit hospitals do. Okay, they also spend 100%, 104% more on land and buildings. They spend 30% more on administrative wages, and their return on assets is 9 percentage points lower. But it's not all bad. They do spend 36% more on charity care, although again, we started the day by acknowledging that's a pretty small share of overall revenue for the organization at any rate, and so it's higher, but it's not certainly at levels I think some of the media might expect if they're talking about charitable care done by nonprofit hospitals. And they also have a slightly higher program expense ratio. And so some of the surplus seems to go to the mission, but a lot of it ends up piling up in ways that, again, if you study corporate governance, are quite predictable because these are large, complex organizations that are just operating without the same corporate governance structure that's in place for for-profit hospitals. The other thing we do is look at hospital conversions. So we look at what happens when a hospital goes from nonprofit to for-profit, and this is simply just a study of the cash on the balance sheet. It's not about where it's going. But you can see that nonprofit hospitals that are about to convert, they all sort of have the same trends in how much cash they're holding, and then they convert, and 1 year later, cash balances fall by 60%. Now, some of those cash balances are going legally to nonprofit funds that are supposed to hold the assets of the converting hospital. So it's not a claim on where they're going, but it is a note that cash comes out of the organization pretty quickly once they're allowed to get cash out of the organization. Another thing we do is we create this oversight score. So we went into state law and we looked for indicators of whether there were requirements for independent members of the boards of directors of the hospital, enhanced community benefits reporting requirements, certificate of need laws, and attorney general oversight of transactions. So we went and kind of coded this up across all the states to see which states have more or less oversight over these hospitals, because that can be a substitute for shareholder oversight. So you can see there's a lot of variation across the United States. We've touched on some of this variation across these sessions already. And what we find is that when we have more oversight in these on the part of states, you have higher margins, which maybe is because you have less discretion for administrative pay. There doesn't seem to be any effect on mission, so charity care, if anything, rises with a higher oversight score. What I will tell you is that when attorneys general have prerogative to review conversions, that cash drawdown I showed you, it falls by half in states that do have attorney general oversight of what's happening to the cash versus states that don't. I would not claim causality. I have to. I have a PhD hat on right now. I don't know why the hospitals were converting. It's just a pure look at what's happening to the cash as you go across. But it's at least provocative to think about that as an interesting place to be looking for answers. And so just to kind of conclude, you don't need the exemption to buy the mission. And by that, this is where Brad started. There are tax expenditures, which are directed deductions and credits to pay businesses and individuals to do the things we want them to do as a government. And so we sort of have to decide what is it we want hospitals to do. And there's more than one way to get to that. One way is a blanket tax exemption. And I'm somebody who sort of worries in my tax land that as long as it's like a blanket broad exemption, it's always going to be hard to count the beans, right? IRS is not a bean counter, but if you're talking about an expenditure and you get X for Y, we have to find a way to pin these things to something quantitative. The alternative is to consider whether these regulations for these large organizations make sense. And if they don't, is there something else we can do to continue to motivate hospitals to do the things that we think they should be doing on behalf of public health and the population, like charitable care and the like? And so there are ways to tie deductions and credits to the behavior we want that can allow us to step away from these broad exemptions. And I would not suggest that's the way to go for the YMCAs of the world, but I might suggest that as you start to break up the tax-exempt sector, it might not be a one-size-fits-all solution in terms of reform.
Hi, that was a great presentation, or three great presentations. I really appreciated hearing from all three of you, very different presentations, and I've been tasked with giving some high-level comments. I'll try to keep these short. so we have more time for Q&A. Brad kind of also tasked me with commenting on kind of data needs, and this is especially salient for Judith's presentation. We at KFF estimated the value of tax exemption a few years ago. I know Lown has done a lot of work on this, Brad and Hossein have as well. And I will say that it was like a very rough estimation, pulling from a bunch of different data sources that are not meant to be used to estimate the value of tax exemption. The roughest assumption we made was around the value of the property tax exemption, because as Judith was highlighting, there's really no good central data source on the value of property that's held by nonprofit systems. And so I certainly commend Judith on like doing what sounds like an extraordinary amount of legwork to pull some of this information together and to make it transparent to the public. It did remind me of a recommendation that Jerry made a few years ago, that perhaps one policy option might be for the federal government to collect some of this information directly from hospitals and from other organizations. I think the proposal was to directly collect information on the property tax exemption, the sales tax exemption, information about charitable contributions, and tax-exempt bonds, which some of which at least is easily available or could be easily estimated by hospitals. Estimating the value of the income tax exemption is much more complicated, but there could still be a process for the IRS to provide guidance, to have hospitals provide some sort of ballpark of estimate of what that looks like. And I say that because I imagine that it would be of substantial interest to federal policymakers, to state and local policymakers, to local communities, to journalists, to the general public, to understand which hospitals specifically are gaining a lot from this tax exemption structure. As we saw through Judith's presentation, as Jerry was also alluding to, there seems to be substantial variation in how much nonprofit hospitals and health systems are actually benefiting from this structure, but there's not very much. There hasn't been very much light shed on that from the public perspective. Now, the Lown Institute does great work in this area, and I think is maybe the one exception. But again, it seems possible that the government could be filling this role to make this information more accessible and more accurate, to identify who's really benefiting and who the public should be expecting to providing more benefit to their communities. I was also thinking about transparency topics when hearing Elena's presentation. I was really intrigued by some of her results. Capital expenditures are something that could be spent on really worthy goals or could be spent on gilded lobbies. And that's another area where I think it would be really interesting to collect more data from hospitals to get a better understanding of what exactly they're spending their money on. And I could imagine that, again, gaining a lot of local interest and understanding, is my hospital spending something, for example, to build a new outpatient center or clinic in an underserved area, or are they using these really to expand the hospital and its prestige in ways that don't clearly tie to the needs of the community? And similarly, I'm sure we'll hear a lot more about transparency in the next section on community benefit. I think even with something like the charity care provision, that's something that is measured indirectly, not totally for the cost reports in the context of the tax exemption. I think there have been questions about the quality of that data and how much it's audited and evaluated, and some questions about what for-profit hospitals are specifically reporting as part of their charity care costs, whether it might include certain broader categories of discounts for people who are not eligible for charity care but paying out of pocket. And then finally, I really enjoyed Cathy's presentation as well. I feel like I haven't heard many people propose the nuclear option of like eliminating the tax exempt status of nonprofit hospitals, but I think she raised a really interesting point that maybe clawing back this benefit in some way may be on the table in the future, given our nation's debt crisis. I've been thinking about this, I think from a like narrower and shorter term perspective, which is that, Congress just passed the One Big Beautiful Bill about a year ago, almost exactly a year ago. That's expected to substantially reduce federal healthcare spending. Hospitals are saying this will have a pretty substantial impact on their finances. I do wonder how that will affect the appetite for broad-based reforms that are going to impose new costs on hospitals or require new spending from hospitals, and how that will affect, in turn, the kind of conversations around nonprofit hospitals and their tax-exempt status. And I'll leave it at there.
good. Thanks, Zach, for those. Is this on? Is this on? Maybe. There it goes. Okay, cool. So maybe just to start with just a kind of a narrowly targeted question, kind of continuing on the issue Zach raised about just data. So maybe specifically for Judith and Elena, like, are there places in particular, like specifically focusing on data that you think are like the strongest needs, the biggest places where we have a gap in our capability as researchers to examine?
I guess I'll kick us off. I don't think we're going to say something super different, like, yes, more data. I mean, again, the implicit exchange that's happening is, maybe $40 billion in tax exemption for something. And if you can't measure that something, I think it makes conversations about whether this tax exemption or some different version of a tax exemption makes sense hard to have. And I think you see that in like the legislative action of the House and the Senate, where there doesn't seem to be a lot of disagreement that we need more data and maybe we need it at the facility level. And some data is easier to get than others, like audited financial data, to my mind. I think it's crazy that we don't have audited financial data. Again, these are not small organizations. I promise you they're producing audited financial data somewhere for debt holders or anybody who's interested in making a serious donation to the hospital, and I think that should be made available to the public. Other things I think are useful, but will be more complicated. Things like property tax is incredibly important, but even the property tax value of your home is a very hard thing to get data reported on, right? That's something that fluctuates with the market, and so I wish we had great data on all property tax values, including hospitals. I think that one's just going to be a harder nut to crack because some states don't have property tax, and in general, valuing that land is actually quite a serious exercise.
Yeah, I think going off of that, there's a couple of I feel like low-hanging fruit here, and some of it's actually being addressed in the transparency bill that passed out of committee. Putting the CMS ID number on the IRS 990. I feel like everyone's just been asking for this, and then oh my God, they listened. Wow, wouldn't this be great if we had this? So that's just fantastic. Also including what are the top 3 health needs that you found out in the needs assessment, and what exactly are you spending on them? Because even though they have these buckets of here's our community health programs, here's our subsidized services, you don't really know exactly what's being spent on the health needs that they've spent so much time identifying these health needs and surveying the community to get them. And they usually don't have any budget numbers in the needs assessment or implementation plan about how much they plan to spend on it or how much they did spend on it. It would be really great to have that either in the Schedule H or somewhere else. I think that would really help transparency. I know we'll probably go into this more in the community benefits section, but we spend a lot of time looking at community benefits, and some of the categories are still super fuzzy. The cash in kind contributions, I've seen a bunch of 990s where they say they're spending over $100 million on cash in kind contributions, but then the bulk of that is going to their affiliated medical school or their physician group, which is technically, that's allowed. It's a 501c3. You're giving them money, great, but really you're just giving money to yourself in a different way. That's not really the spirit of the thing. So getting more insight into that would be super duper helpful.
Great, thanks. Yeah.
Yeah,
sure, go.
Sorry, I just wanted to add one comment, which is that I think everyone in this room is really interested in more transparency around community benefits and the value of tax exemption. I did think it was interesting that this Tax-Exempt Hospital Transparency Act passed out of committee on a partisan basis, even though you think of transparency as this very low-hanging fruit for addressing any public problem, it still seems like there may be political challenges in this kind of area.
One brief thing I can just say about the data is, so one of these 6 pieces of the tax exemption is essentially these indirect benefits from tax-exempt bonds. And on one hand, from the hospital cost reports, the amount of dollars they have in bonds, but in some sense, the other piece of that to really get an estimate of the value is essentially getting the TIC, the true interest cost of that bond. And that's really hard to get. But a colleague at UNH, we're starting to kind of go down that path and go into the bond market to get some of that data. Let's pivot to a separate issue, which has come up a lot, both earlier but also now. Just the wide variation in some sense, there's wide variation in community benefits, but we're kind of leave that for the next session. But we just kind of focus on the wide variation in the tax exemption. It's kind of struck me that you can probably put these into two broad groups with respect to like the hospital's perspective, right? Things that they can't really control, right? You're either in an area with a high property tax or a low property tax, or you're in a state with a high corporate income tax or state with a low corporate income tax, sales tax as well, right? There's just kind of things when you estimate that value of the tax exemption, the hospital can't control it, right? And speaking to the property tax, right? Whereas on the other hand, there's probably a whole bunch of things that you could put in the other bucket of, well, these are things that are actually within the hospital's control. So I guess first question is like, do you kind of agree with like that broad characterization? And then if so, are there additional things that you can think of, maybe particularly on the hospital side, in terms of hospital behavior that influence the magnitude of the tax exemption that necessarily hasn't really come up yet?
I guess like my thought on this is that speaking of in the property tax, but it also relates to other things, is that because you're exempt, there's another incentive to grow and get bigger and bigger, right? Like, and to acquire more property. And even though most of the property we found was all commercial status, there are some hospitals in New York City that own a lot of residential property. And I think it's for like employees or trainees or whatever. But like, why not grow, how much you own if you don't have to pay taxes on it? So there's a consolidation implication there, I think. That was just my first thought.
Yeah, I think I agree with that like while the property tax itself is not something the hospital chooses, where they choose to build is going to be highly endogenous to the property tax structure that surrounds them. And so that will influence the size of the exemption. Also, I think somebody earlier said that hospital prices are made up. I mostly agree with that. They're of course not made up, but I mean, even when you talk to the health accountants, they're a little bit shocked when they start to wade into hospital pricing in particular and how distinct it is from the pricing of really any other good or service in the economy. And if you think about the value of the exemption, some of the value of the exemption comes from where revenue lives, and whether you're talking about list prices or discounted prices, and all of that, again, is kind of endogenous or like twisted up in the system we have right now. And so it doesn't surprise me that there's a lot of variation in the expenditure. There's also a lot of variation in hospital organization. We have a couple huge systems. We also have one-off singular hospitals, and all of that is going to mean that I think the exemption, I would never have been surprised, and it's good to see something that corroborates my intuition that it's a highly concentrated expenditure, just like the industry itself is very concentrated. And so that doesn't surprise me.
Considering we're here at Hopkins, is one aspect, if we're kind of thinking about variation within nonprofits, is academic medical centers versus others. Is that something? I mean, certainly kind of again think about that impacting community benefits, but is there something we can kind of think about that in terms of variation in the tax exemption? And in some sense, I think we'll probably try and broaden out a little bit more to just thinking about hospital finances in general, but our academic medical center is an important piece for us to consider here.
I mean, I think that comes back to where we started the conversation, which is like the data is very quirky. I mean, academic medical centers are in, for example, the HCRIS data, but they're hard to find in the 990 data because a lot of them are attached to state universities, and state universities don't have the same 990 reporting requirement that like Yale University has. And so there's a transparency issue with academic medical centers. I also will say that I was at a conference at a different university that had a very large medical center, and the president of the university was sort of touting the healthcare system and all of the profit it throws off, and like how great that is for the subsidy of the education campus, one hopes, and not the football team, but how much profit the medical system is throwing off, and that is like kind of sitting there and available to the university to use for other things in a cross-subsidy kind of way. And so the integration of health and education, I think, makes the question even that much more complicated because it's very hard to separate. I think legally, in terms of data, in terms of everything, those two entities when they're tied up together in universities.
So maybe continuing this theme about thinking about the broader like political implications and the effects of reform, and maybe even broadening out beyond just thinking about the tax exemption to I think one piece that was in the title of the session, which is fiscal realities, financial realities. Talk a little bit about how the Affordable Care Act first, but maybe more recently the Big Beautiful Bill, and then maybe put on your prognostication hat in terms of like what things are coming down the pike, how this might impact hospital finances broadly, but maybe tax expenditure more specifically.
I don't know if this is on. It's not. Okay. Yes. And I do not study hospitals. I was up here for a history lesson, but I would seriously. But I would say, the premium tax credit, which is now worth about $500 billion over 10 years, which is not nothing, and the cessation or some of the premium tax credits in was OB3. I wonder, I'm just asking really, how is this going to impact hospital community care? Like, what are people going to do without that? I would think there's some spillover impact that is not negligible.
That's what I would have said, is that I think the biggest pressure right now is the sort of wind down of the expanded premium tax credit from the COVID pandemic era and the rising premiums. And those are twisted up in each other. The reason why premiums next year are going up is because uninsurance rates are going up and the pool is all messed up now. And that's just going to mean, I think we are, for the first time in a long time, in a period of rising uninsurance. And once you're in a period of rising uninsurance, combined with the changes in the One Big Beautiful Bill Act to healthcare and Medicare financing, I think that small hospitals are going to struggle. I think all hospitals will tell you they're going to struggle because it's in their best interest to say this is really hurting us. But my instinct is that the smaller hospitals and vulnerable communities are really kind of getting hit from all sides right now. And it is, to me, the thing I worry most about is just this rising uninsurance rate that we haven't had in a long time that is coming from the marketplace dynamics that are unfortunately doing the things that we all thought they were going to do.
Yeah.
I'll just say on top of that, so, part of the story is obviously that the CBO is projecting there'll be 10 million more people without insurance by 2034. And that obviously means something, most importantly, for the people losing health insurance, but also for hospital finances, as these hospitals take on more uncompensated care and see fewer paying patients. There are also other provisions that are expected to reduce Medicaid payments to hospitals, including restrictions on provider taxes and state-directed payments. I do, as I mentioned before, it seems like this might have reduced the appetite for, broad policies that would target hospitals. I think in general, there's also less kind of public interest in targeting hospitals versus like pharmaceutical companies for various reasons. I do also wonder kind of this countering story, which is that we're now going to have many fewer people without Medicaid coverage, many more uninsured people. Is that going to bring much more attention to the financial assistance programs that hospitals are providing as this kind of insurer of last resort for people who are otherwise slipping through the cracks? So I do kind of wonder if there'll be more attention to those programs and to hospital debt collection practices, which we've seen over the past few years in the context of rising uninsurance rates. There's certainly safety net hospitals that are going to be especially hit by this bill that are already, struggling to stay in the black. And I think everyone understands that these hospitals are providing a lot of community benefit. There could be more scrutiny of the kind of haves in the hospital space who are, continuing to go after patients despite their nonprofit status.
I think there's one other tax wind in the background that's probably less obvious to the people in this room, but the state fiscal situation matters quite a bit too. And there's a wave in certain states now to be thinking about, for example, getting rid of the property tax completely. And that really upends local and state fiscal pictures. And so it's not clear how successful this will be, but I have noticed in the last 3 or 4 years that there's a lot of conversation about just getting rid of the property tax at a time when federal to state transfers are already very low right now. It sort of raises the question, fiscally, what are states going to be doing to support public health and community needs, and how much are they going to be leaning on hospitals at a time maybe when they might be like the least equipped to be able to do that.
So if I'm thinking about something I kind of led with, which is the nonprofit tax exemption as a piece of broader tax expenditures, and then you, Cathy, kind of, talking about the bigger picture budget issues and politicians being interested in kind of chipping away or contracting tax expenditures as a way of raising revenue. Kind of strikes me that that's not actually something you can really do with the nonprofit tax exemption, right? So you can think about there's deductions, there's credits. We can kind of think about shrinking those or modifying eligibility a little bit. But when you're talking about the nonprofit tax exemption, it's kind of like you're either a nonprofit or you're not, right? And so I'm wondering, are there incremental things you can do in the nonprofit sector on the tax exemption side? I think there's discussion that'll come up later about thinking about community benefits, maybe we can try and tweak things there and modify things incrementally. But are there incremental reforms that can happen on the tax exemption side, specifically in terms of the financing? And I'm not really sure I see it.
I think it's just a really complicated question. I think some politicians, for example, will say, we're just going to get rid of the tax exemption. And again, I'm going to put my toe in the legal water and let the legal experts say this probably more clearly, but that's not actually a very easy thing to do, right? There's not a single provision that says hospitals are out, although they do have the provision of healthcare. Again, what do you mean about university hospitals that are exempt because they're part of universities, or those that are affiliated with religious organizations? It's actually not a thing you can snap off. And I think the reverse is that we kind of change the community benefits requirements, or we maybe impose some minimum financial assistance program on hospitals. But it has to be that the threat you have in the back of your mind is that IRS is going to revoke the exemption. And IRS is not a top fighting strength right now. GAO has already said, and IRS keeps saying, look, we really can't police this. It's not within the scope of what IRS is able to do right now. So if you're not also willing to follow up with, you better spend 5% of revenue on charity care or else you don't get the exemption with a revocation, which hasn't been the case forever, it's hard to make those threats. And so I do think there's appetite for reform. There have been quite a few Senate and House hearings, and every once in a while people get outraged about it. However, I think the solution space is a lot more constrained than people realize it is because of the way all of these laws kind of come together, and with the state that the tax administrator is in, which is bare bones right now.
Yeah, I think when we talk about this kind of stuff, we talk about squeezing things, making sure they're more efficient, more effective at delivering. Again, there are a lot of tax expenditures out there where it doesn't really change behavior. For instance, I have a 401k plan, and it's tax deductible. Am I going to save anyway? Yeah, I'm lucky, to some extent that I can save. It doesn't change my behavior one bit. And that's the kind of thing we look for when we're, trying to raise money, in finance committee where I used to work. That's the kind of chipping away at things that is usually your first tranche, right, of trying to raise money to address budgetary challenges or pay for other priorities. And there's a lot of, you can imagine this kind of tightening can happen across a broad spectrum of things.
Yeah, I think I agree that if we want to change the behavior, we should just agree on what behaviors we want them to do. And I don't think we've come around to this yet about literally what do we expect a nonprofit hospital to do and to be. And I think if I were in charge of a hospital, I would be so confused because I'd be like, I need to do my job to provide clinical care, but also I need to make sure that I'm able to survive financially, but also I need to do this community engagement and go out into the community and work with other people, but then other people are saying, no, that's too woke, don't do that. So I would just be incredibly confused about what am I supposed to do. I mean, I think given what's coming down the pike with HR 1 and so many more people are going to be uninsured and going to need care, I feel like if we can just agree, don't sue patients if you're a nonprofit, don't please give free care to everyone under 200% federal poverty level. And if hospitals can't do that without going bankrupt, then we have a serious problem that we need government to fix and then that's what we need to do. But like we haven't really agreed on exactly what we want hospitals to do or be yet.
So maybe the last thing before opening it to the broader group, and in some sense, like probably spending a lot of the day really beating up on the nonprofit tax exemption, right? Really punching it. But in some sense, like, can we kind of take a step back and kind of ask, like, well, what is like the underlying rationale or appeal of using either the nonprofit tax exemption in particular or just tax expenditures more broadly? Like, what's either the economic efficiency argument or maybe like the political realities of taking this approach as opposed to just saying, look, we're just going to increase taxes and increase spending, and the increased spending is how we're going to achieve these community benefits?
I mean, from a tax policy perspective, we've, sometimes the easiest way, broad-based, low rate kind of increases. But what ends up happening is people also want, to impact behavior. You want people to go to school, so you give, kind of school loans and et cetera. You want, the tax code is a really good, maybe it's a tool for directing behavior and for and it's perhaps overused in some cases, but that way you're actually encouraging certain behaviors. That's the whole idea of tax expenditures, is to encourage certain behaviors, discourage others. Doesn't always work, and we don't usually go back and check. We only go back and check when we need money. So you might do something years ago, and it was a great idea, before we had calculators, and now all of a sudden you're still, giving outdated incentives, but they become very entrenched. People who have them like them. But broad-based changes in tax levels and then other kinds of laws to direct behavior seem to me to be a little bit of a better match. But that's not how we do it. Jen.
Okay, let's go to the audience. I think someone will come to you with a microphone.
Good afternoon, Siobhan Laird, Bon Secours Mercy Health. And I'm going to ask a question. I'm not sure I'm framing it correctly, so bear with me. So what I've heard you all saying is that the data is limited or flawed in terms of understanding whether or not hospitals are living up to their potential. And in the space of that, what I've heard a lot of today is kind of the narrative of the outliers being shown as, okay, here is what we're trying to get away from. I also know that we just talked about this idea that we need to change behavior, but we're not clear on what the final behavior that we actually want from hospitals is. So in light of all of that, I start to wonder whether we, to what extent we should even be having a conversation about changing the current law or regulations if we can't, unless we can gather better data to determine whether there's a problem or not truly. And then on the back end, how would we even determine whether the new version of the law or regulation is working?
I mean, I totally agree with that. I think that's been underneath a lot of what our conversation has been about, which is that, this exemption is very broad and it's very squishy and the data is not that great and we wish we could measure it better. And I think you see that in the only thing that's come out of committee has been you need to report better data. That's the Transparency Act. And so I see that as kind of a down payment to be able to have conversations about reform, assuming that we can get to a place of facility level benefits reporting. And then maybe once we see that, we'll say, well, benefits 1, 2, and 3 make sense. Benefits 4, 5, and 6, maybe that's not what we meant. But I think you're right that the conversation is sometimes in a policy space all over the place, in part because we've gotten to a very broad definition of what we mean by community benefit, and then it's not measured very well. And so that's it's a foot fault out of the gate, and so to speak, in having a conversation for reform. So I think everything starts with better data.
I do think that there's, I mean, obviously, the question of what do we actually want is a decision that policymakers have to make and the public has to make. I do think there has been some groups that have coalesced around some minimum standards for financial assistance. Some states have certain requirements that hospitals extend eligibility to certain groups of patients at a minimum. There are also these efforts to make sure that hospitals are ensuring the people who are eligible for financial assistance actually receive it, which is, I think, something we have like very little knowledge about. But states can require, for example, that hospitals go through some sort of basic presumptive eligibility process to make application easier for patients. So I do think there's like some minimum standards and agreement on the basic things that policymakers and the public want hospitals to be doing. There are questions about what happens beyond that because, as we've been discussing, financial assistance is just one kind of small component of what hospitals are reporting as their community benefits.
Good afternoon, Dave Zuckerman with the Healthcare Anchor Network. I guess just building on Siobhan's comment and question a little bit about as we think about that broader public policy discussion of what we want, what encouraged us to keep that aperture broader beyond just charity care, because I think that some of the data that Dr. Anderson showed at the beginning around the shift towards focusing upstream has been a hard-fought battle by public health and community development to get hospitals to that table to think more broadly about their role. And even if they aren't doing it well, the beginnings of their efforts to go in that direction, it seemed like a really important one. My question specifically is for Dr. Patel. I was really fascinated by the governance comments related nonprofits for for-profits. From a public goods perspective, I would think that keeping those dollars within a community rather than them being extracted out to shareholders is a benefit. And I guess from your perspective, you talked about the regulatory environment of attorney generals. I guess what else do you see that would strengthen the overall governance of the institutions to ensure that those dollars that are being retained in community are benefiting, I guess, this broader mission of health promotion?
Yeah, I think if I were to say one more time what was in that oversight score, some of it was sort of minimum reporting requirements on behalf of the community. And so I think what we worry about in a governance space is just like who is the ultimate stakeholder. And I think the language right now is that the community is the stakeholder in the hospital's returns. But I don't know that there are enough safeguards in place to ensure that those dollars are spent on the community. I don't think we know what we mean when we say you should spend those returns on the community. I also think it's really important to underscore that to spend on the community, you have to have returns to spend on the community. And so there is a financial discipline element of running these, sometimes 10 or $100 million organizations to ensure that you get high ROA, not necessarily to extract to shareholders, but to ensure that you've got the ROA and the returns to be able to spend on the provision of unprofitable services, because you can't run a deficit financially to run a hospital and to spend on the community. And so that's the tenor of, I think, what oversight can bring, which is like requirements about who should be on the board of trustees of hospitals to help monitor those things on behalf of the community.
Hi. So this is kind of related to both of these questions, but if we were to take, say these are the things that we want charity care to be, keep the aperture open, but if it was to at least include don't sue patients and provide free care for people under 200% federal poverty level, it could be more than that, but those two things that, as part of the baseline. If that was to be agreed upon and using instead of having hospitals provide evidence of that and providing data around that, saying the high rates of medical debt amongst these populations is proof enough. Hospitals are charging them bills they can't afford. That's the proof. We have it already. If we were to take that as one of the goals, what levers, policy levers at, I guess, the federal level or state level could compel hospitals that have all that surplus to take that money and invest it in those two things, not suing patients and providing free care? It sounds like the IRS is not the body to be doing that. But what is the way to make that happen?
Yeah, I mean, there are states that have done things about this, and then especially adding in, like Zach said, the screening component to make sure that everyone who's eligible is getting it. I do think in a way, like, the tax exemption has been used as that kind of lever. In Indiana, this was passed last year, I think. They basically set if you want to keep your tax exemption, this is just like the top 5 nonprofit hospitals in the state, because those are systems, because those are like the big ones that exist there. They said you have to get your commercial prices to the average state rate, or as it was, the average state rate baseline. You got to get your prices down within a matter of 5 years. Otherwise, hey, you don't have to be tax exempt for the state anymore. So I think, like, it is an important lever, and like we were talking about before about what's the benefit to this, I don't think that the way the tax exemption works is really the way that anyone would want to structure it now, given how large some systems are. But that given that it already exists, I think we can use that as a policy tool.
I think Misha had a table on one of her slides that was the growth in assets of some of these big New York City hospitals. And I'm not aware of anybody who's tried to throw in the tax expenditure, the size of not taxing these enormous investment portfolios. But it seems to me like it is maybe the biggest. I just looked at the number 3's consolidated annual financial reports, and they're at 50 billion. 50 billion, like, I think it is assets minus liabilities. So that's net. They're at like 50 billion. And a lot of that is stocks and bonds, private equity, hedge fund, derivatives, things I have absolutely no idea what it means, but they're hedging all their interest rates and all that kind of stuff. And I'm just thinking that, like, the cash isn't going out. The cash is piling up.
Yeah, I mean, I guess I would just say a couple of things. We had a little bit of this conversation in the One Big Beautiful Bill Act. That was really directed at university endowment funds. But you could imagine extending that kind of political conversation to a different style of endowment tax on nonprofit hospital holdings, for example. Again, I'm a little bit like where we started. This conversation is really awkward for a couple of reasons. If a hospital told you and you believe them that what their endowment returns are doing is producing returns to be able to provide OBGYN services in rural areas, then you may be like, oh, I'm not so mad about that. And again, something has to produce positive returns to be able to provide charity care, to be able to invest in communities and services that aren't profitable. And so to me, like, the offensive thing is not the existence of returns, right? It's just a question of how those returns are spent. And that's where we come back to, I think, the bigger conversation I like to have, which is, again, around governance and who's making choices to make sure that returns are at appropriate levels, right? If we're going to use returns to spend on community health, I hope we have enough returns to do that. So we want to be optimizing that in some sense, but also to make sure they're spent on the things that we want them to be spent on and not the mahogany desks, which of course is just like the pithy thing that we say. But this is the point, is that I just think that this space is really messy. It's really messy because it doesn't have a lot of, even though it seems like there's a lot of oversight, they're just enormous organizations. And if you're waiting on the IRS to provide the oversight, unfortunately, you're going to be waiting a really long time because they have a lot of priorities and they are not specialists in overseeing healthcare systems. And so I think we just don't have the right pillars set up in place to be monitoring hospitals to ensure they're doing the thing we want to do. And we really just haven't been clear about the thing that we want them to do. So there's problems on all sides of the ledger, I think.
If I could just offer like one concluding thought, because I think we're at time, unless Susan will give us some extra time. But kind of following on your question about there's this, you see all this wide variation in tax expenditures, wide variation, as we'll talk about in the next session, community benefits, and there's like a lot of appeal of saying, well, let's set a floor and expect all the hospitals that are underneath that floor to raise their level. Sounds kind of appealing on the surface, right? But the thing that worries me a little bit is that then you get all the hospitals who are up here saying, oh, shoot, that's all I had to do, right? Like, in some sense, like this ambiguity from the IRS is possibly, I'm just trying to think of like an argument for it, right? Like justification for the ambiguity. The ambiguity actually gets a lot of players like saying, well, I don't know what I have to do, so at least I better maybe try and overshoot. Because if we set this floor, then I worry hospitals will just say, oh, okay, I'll just do the floor. And then we get less variation, but overall we're a little worse off.
Because most of these large organizations are department level contracting well. So I'm less worried about these things, but it is quite possible.
I would just say like a floor can be appealing. This is like the second lowest silver in the ACA. We set floors all the time and they're imperfect, but they can be good thresholds. I think they're like, it's never going to be the case even with the floor, just to say this, because it's important to say that that means hospitals are never going to sue patients. I think there might unfortunately be some patients that aren't paying their debts and you have to go after them. And so like you need rules to say that are easy to follow, easy to administer, so patients know, yes, I am eligible for free or reduced care, right, to make that administration easy. But then you have to recognize that like putting those rules in place doesn't mean nobody ever again has medical debt. That's a totally different issue than I think determining a hard question, which is like, what is the appropriate minimum amount of charity care and what are the costs and benefits of setting a minimum, which might be that might pull down charity care for some hospitals, it might bring them up. And, you know, it's just, we're always in, as we say in tax policy, like a seventh best world, because we can't get to the first or second or sixth. And so we just have to decide what is the seventh best circle we can get into.
Well, I just want to point out, like, the variation is showing how our health system has different tiers, where you have hospitals that take care of a disproportionate number of uninsured patients, patients with Medicaid coverage, by virtue of where they are, or maybe their history as a hospital serving those patients, and maybe maybe the existence of that hospital taking care of those patients, like that is their community benefit, great. And then maybe there's a hospital that's over in a wealthy suburb where they're not going to see that many uninsured patients, and they get that benefit of getting that private insurance money, but they should still have to give something. Maybe they're giving a subsidy to the other hospital. Maybe they're doing it through community health programs that reach a broader lens. I think it's really tough to find out how to actually put that into a policy, but either we have to change our system to make it equal and not two-tiered system, which I would like, or we have to find a way to kind of even the scales a little bit.
This is wonky and maybe a conversation about a policy that will never happen, but I remember there's an interesting proposal from Brookings several years ago to create basically a cap and trade system where, you know, wealthy hospitals that are earning really high margins and theoretically benefiting a lot from the tax exemption would subsidize the provision of care and other community benefits in underserved areas.
Just to say the super sarcastic thing, if we had a single healthcare system, then it might do that automatically.
Well, on that thought, join me in thanking our excellent panel. I really loved it.